Stop. I need you to understand something before a single other thought enters your head today. 6 days ago, this war began with one wave of strikes. Today, the Israeli military has confirmed Wave 10 against Tehran. 10. And gold, the metal that absorbed a 21% correction from its all-time high, that survived the war shock that held while every tourist sold, gold sits right now at $5,141. Perched on the 61.8% Fibonacci retracement like a coiled spring, they want you to focus on Tuesday's 6% crash. They want you to believe the safe haven narrative is broken. It is not broken. It is loading. It is Thursday, March 5, 2026. Wave 10 has landed. The 61.8% golden ratio is the line that separates recovery from reversal. Ladies and gentlemen, Vault Tracker here. 3 forces are converging on gold right now. You need to understand all 3 before Friday's payrolls pull the trigger. Silver is heating up, and this move could surprise the market. Let's break down what's happening right now. If you want clear and powerful silver market updates, make sure to like, subscribe, and follow John AG World for the latest analysis. Let us map the exact structure gold is building right now, because the 61.8% Fibonacci level is not an arbitrary number. It is the golden ratio, the most respected retracement level in all of technical analysis. And gold is sitting directly on top of it. The Fibonacci framework. Analysts note the 61.8% Fibonacci retracement measured from the $4,402 corrective low to the $5,598. All-time high sits precisely at $5,141. Market trackers confirm gold is currently trading between $5,141 and $5,175 Thursday, with an intraday range from $5,092 to $5,200. The previous session closed at $5,123. Today's early gain of approximately $52 marks the first positive session after Tuesday's devastating 5.5% crash. The 61.8% level is the battle line. When the golden ratio absorbs selling pressure and price recovers above it, the measured destination becomes the prior high. The measured move from $5,141 back toward the all-time high at $5,598 delivers an approximately $457 upside objective from the current foothold. The moving average cluster. Sources confirm gold's 21-day SMA sits near $5,080. The 50-day and 100-day SMAs cluster below 4,900. Every single moving average from 21-day through 100-day is below current price. Every single one is trending higher. That is the textbook definition of an entrenched uptrend. Short-term volatility does not erase an entrenched uptrend. It tests it. Tuesday was the test. The 61.8% level held. Uptrend confirmed intact. The RSI reading. According to analysts, the RSI has lifted back into the mid-50s after cooling from prior overbought extremes. Mid-50s RSI inside a bullish structure is the most constructive available combination. Not overbought, not oversold. Momentum rebuilding inside a confirmed uptrend, with room to extend substantially before the next ceiling. Resistance levels above. Market trackers confirm key resistance at $5,320.89, with a bullish scenario pointing toward $5,426 and higher. Longer range projection models target $5,553 in the medium term and $5,900 by June. Below the 61.8% at $5,141 is the first defense. The 50% Fibonacci retracement near $5,000, the psychologically critical round number, sits below as the final bastion. Analysts note this level is reinforced by the rising 21-day SMA converging to create a demand zone of exceptional density. Sustaining a break below 5,000 on a daily close basis would require simultaneous failure of the Fibonacci structure, the SMA cluster, and the psychological floor, a low probability scenario, while Wave 10 geopolitical premium, a dovish Fed narrative, and China physical demand remain structurally active. According to reports, technical patterns confirm hammer and dragonfly doji formations forming near key support at $5,153 Thursday. MACD continues rising in negative territory, bearish momentum fading, RSI at 47 and rising toward 50. Every momentum indicator points one direction: recovery building, not collapse extending. 5 geopolitical and macro developments landed on Thursday, March 5th that are exclusive to this script, none covered in any prior analysis. Together they form the most concentrated gold bullish catalyst bundle of this entire 6-day war. The first Wave 10 confirmation. According to reports from live war coverage, Israeli forces confirmed the launch of a new broad wave of strikes targeting Tehran's military and regime infrastructure, the 10th coordinated strike package since the war erupted on February 28. Sources confirm IDF spokesman Avichai Adre confirmed strikes on dozens of Basij paramilitary headquarters across Iran's capital, missile launchers, air defense systems, and supply logistics facilities. Casualty tracking sources report the total death toll from U.S.-Israeli strikes has now climbed to 1,230 per preliminary tracking data. Reports additionally confirm the IDF achieved the first stealth fighter air-to-air combat kill in history. An Israeli F-35I shot down a Russian-made Iranian Yak-130 fighter jet over Tehran. Military milestone that confirms the scale of operational dominance being established over Iranian airspace. The second catalyst, naval expansion. According to reports, the conflict's naval dimension escalated sharply Wednesday when a U.S. submarine sank an Iranian warship off the coast of Sri Lanka. This is the first confirmed naval engagement in open ocean, beyond both the Strait of Hormuz and the Persian Gulf. A naval vessel hunted and destroyed in the Indian Ocean confirms the war's geographic footprint has expanded into global shipping lanes that carry implications far beyond Hormuz alone. The third catalyst, NATO's direct involvement. Sources confirm NATO air defense systems intercepted an Iranian ballistic missile aimed at Turkey on Wednesday. Turkey is a NATO treaty member. Iran firing a ballistic missile toward Turkish territory introduces the possibility of broader NATO involvement into a conflict, until Wednesday characterized as exclusively a U.S.-Israel bilateral campaign. Article 5 discussion risk, even at the level of possibility, represents a geopolitical escalation the market has not fully absorbed. The fourth catalyst, Warsh's dovish reinterpretation. According to reports, Trump officially nominated former Federal Reserve Governor Kevin Warsh as next Fed chair Wednesday. The decisive distinction from January's Warsh crash, the current market reading has completely inverted. Analysts now characterize Warsh as sitting in the pro-easing camp and likely to lower rates later in 2026. A dovish incoming Fed chair means rates fall, dollar weakens, real yields compress, and gold, the world's premier zero-yield asset, becomes structurally more attractive as real yield compression widens the price gap between gold stability and bond returns. The fifth catalyst, China's growth signal. Sources confirm China officially set its 2026 economic growth target at 4.5 to 5%, a marginal reduction from the 5% rate delivered in 2025. China is the world's largest gold consumer. When Beijing officially signals growth deceleration, domestic physical gold demand historically accelerates as wealth preservation behavior intensifies within Chinese households and institutional channels. This is not interpretation. It is a behavioral pattern embedded across multiple prior Chinese economic slowdown cycles. The sentiment architecture of gold's market right now reveals two entirely different investor populations operating simultaneously, reading the same price, drawing opposite conclusions, and the outcome depends entirely on which population's time horizon the market ultimately prices. Population 1. The war tourists. These investors entered gold between $5,200 and $5,400 per ounce Monday and Tuesday when the initial war premium surge triggered FOMO across precious metals. They saw $5,400 intraday Monday and believed the run to the all-time high was days away. When Tuesday's crash delivered a return to $5,041 instead, their conviction broke, their leveraged positions liquidated. Reports confirm the selling was indiscriminate, a mechanical unwind of overcrowded positions across multiple asset classes simultaneously, driven not by gold's thesis breaking but by inflation repricing forcing broad margin reduction. Sources quote strategists characterizing Tuesday's move as a flight to liquidity rather than a fundamental reassessment. Flight to liquidity means forced selling. Forced selling means ownership transferred from weak hands to strong ones, not the bull market ending. The tourist transfer completing. Population 2, the structural holders. These are the institutional funds with 8 consecutive months of inflows. The central banks projected to absorb 755 tons in 2026 per JP Morgan's demand model. The sovereign wealth managers for whom 5,141 is not a danger zone but a procurement window. According to reports, analysts at Tier 1 institutions had characterized any significant pullback from crowded long positions as a clearing mechanism and re-entry opportunity. That re-entry is now executing Thursday at the golden ratio level. The tension resolves by time horizon. The tourist's clock runs 48 hours, the structural holder's clock runs 12 months. The tourists are gone. Thursday's price action shows what remains. Structural conviction holding the 61.8% line. According to analysts, Societe Generale's research desk described gold as their most preferred hedge, specifically a diversifier that extends performance during oil shock environments. An oil shock environment where Iran has now fired ballistic missiles at a NATO member is not receding. It is deepening. Every deepening of the geopolitical architecture adds another layer of permanent risk premium to gold that no single Tuesday paper flush can remove. The sentiment thermometer. RSI mid-50s. Not panicked, not greedy. Measured conviction rebuilding inside a confirmed uptrend. This is exactly the configuration gold needs to absorb the next escalation headline and channel it into directional price movement rather than a volatile spike and reversal cycle. Community trackers confirm technical pattern signals, hammer and dragonfly doji formations near the 5,153 support zone, both of which historically signals potential price reversal from testing lows. MACD rising in negative territory confirms bearish momentum fading without yet flipping positive, the early-stage recovery configuration that precedes the next trend leg. Let us dissect the primary bear argument for gold on March 5th, because understanding precisely where it fails is the key to understanding why 5,141 is a launchpad, rather than a ceiling. The bear argument. Oil-driven inflation permanently breaks gold's bull run by forcing the Fed to hold rates elevated. The chain, Iran war drives crude higher. Crude drives inflation expectations higher. Higher inflation prevents rate cuts. Rate holds sustain real yield elevation. Elevated real yields increase gold's opportunity cost versus yielding instruments. Institutional capital rotates out of gold into bonds. Therefore, the war ironically kills gold. The fatal structural flaw, it ignores the simultaneous Warsh-dovish pivot. According to reports, Trump chose Warsh specifically with rate reduction as a policy priority. The incoming Fed chair is now characterized as pro-easing. The oil inflation dynamic does not automatically force prolonged holds when the incoming monetary steward is aligned with rate reduction. Instead, it creates a policy tension. Inflation pointing one way, growth concerns pointing another, Fed leadership favoring easing, that gold thrives inside. Not certainty, contested policy territory. Gold is the premier beneficiary of contested monetary policy environments because it carries no counterparty risk and cannot be undermined by central bank decisions regardless of direction. According to analysts, TD Securities wrote ahead of the conflict's escalation that speculators who had been reducing long gold exposure could see Middle East developments as an opportunity to rebuild positions. A Tier 1 bank actively communicating re-entry thesis at current levels, while Wave 10 launches and Warsh nominates dovish and China lowers growth target, is not a marginal positioning note, it is a structural signal. Compare gold's 2026 performance to the critique against it. Gold entered January trading near 4,100. It now trades at 5,141. That is a 25% advance in 64 calendar days. The war launched 25 days after gold had already established this upward trajectory. The structural advance predates the geopolitical catalyst. The war is not the cause of the bull market. It is the accelerant on a foundation already built by central bank buying, dollar debasement risk, and Fed rate cut expectations. All three of those foundational pillars are still in place. Wave 10 adds a fourth. The most dangerous position in current markets is not long gold at 5,141. The most dangerous position is being flat or short while assuming Tuesday's one-session mechanical flush represented a verdict on the structural case. It did not. It was a temporary transfer of ownership from over-leveraged tourists to institutional structural holders. The 61.8% level held. The uptrend is intact. Wave 10 is confirmed. The Warsh-dovish narrative is live. China's physical demand floor is rising. The spring is compressed. The measured move from 5,141 back toward 5,598 and beyond represents more than $400 of open upside. That is not a coin flip. That is a structural opportunity sitting on top of the most powerful Fibonacci support level in gold's current technical architecture. 5 levels, 2 scenarios, 1 war room battle plan through the next 7 trading sessions. Level 1, the golden ratio floor, $5,141. Analysts confirm this is gold's 61.8% Fibonacci retracement from the corrective cycle low of 4,402 to the all-time high of 5,598. Gold holds this level Thursday. Any daily close below 5,141 shifts the probability profile toward testing 5,000. Diamond hands hold above this line. The institutional floor is here. Below it is not collapse territory, it is the extended reload zone. Level 2, the psychological fortress, $5,000. Sources confirm the 50% Fibonacci retracement near $5,000 sits adjacent to the rising 21-day SMA, creating what analysts describe as a demand zone of exceptional density. A daily close below 5,000 on heavy volume is the first structural warning signal. Above 5,000, every dip is structurally supported by multiple overlapping technical factors simultaneously. Level 3, the immediate recovery gate, $5,200. Reports confirm gold is testing 5,200 in Thursday's early session. Market trackers project Friday's expected range between 5,107 and 5,208. A daily close above 5,200 restores the recovery arc with genuine velocity. This is the level above which momentum algorithms reactivate. Level 4, the war premium return, 5,320 to 5,426. Analysts note key resistance at $5,320.89 with the bullish scenario targeting 5,426 and above. This zone represents the peak from Monday's war opening session. A return to and break above this level confirms the full war premium recovery and sets up the challenge of the all-time high at 5,598. Level 5, the explosion target, 5,598 and above. According to reports, breaking above the all-time high opens Fibonacci extension targets towards 6,100 in the near term and beyond. Analysts note J.P. Morgan's structural target of 6,300 for year-end 2026 was established before Wave 10, before Warsh's dovish confirmation, and before China's reduced growth signal. All three of those developments are now layered on top of that existing forecast. The 6,300 target has three new tailwinds that were not factored when it was published. Scenario 1, NFP softens and Warsh dovish holds. Friday payrolls print below 150,000. Dollar retreats below 98. Gold breaks above 5,200 on Friday session. Path to 5,320 opens within 3 trading days. Diamond hands who added at 5,141 see first target within the week. The spring releases. Scenario 2, NFP beats and dollar spikes briefly. Payrolls beat above 200,000. Dollar briefly spikes above 99. Gold retests 5,141. The 61.8% level holds again. The backup truck window extends one more week. Wave 10 Warsh dovish and China demand structural pillars do not disappear because of one strong jobs number. They compress the spring one additional turn before the next release. What is your call on Friday? Does the data soften and unleash gold's next wave, or does it delay the breakout by one final week? Drop your answer in the comments. This is Vault Tracker out. Wave 10 is confirmed. The 61.8% is holding. Stack accordingly. That quotes it for today's silver update. The market is setting up for a potential big move, so stay alert and stay prepared. If you found this analysis helpful, don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss an update. This is John AG World, bringing you clarity in every market move. See you in the next one.